Year 1 activity between the parent and the sub. Remember, we're going to account for this investment using the equity method of accounting. We'll do this throughout the year, and we'll continue to do that year after year. We'll do the consolidation at the end of the year and kind of undo the effects of the equity method each time. If you look at the handout for year 1, you're going to see that the sub reported $167,940 of net income and $154 of dividends. We see that here. A couple of things I want to point out. The first thing is, notice that the net income subsidiary does not equal the income sub. The reason for that is that the parent is only getting 80% of that sub's net income. Remember, we're doing the equity method accounting during the year, so the parent will get 80%, and in this case the sub has 20%. They'll do the same thing on their records, and they'll get 20% of this income, but we're not going to worry about the NCI portion. We're just concerned with the parent portion. I've taken their income statement and just broken it down, 80% to the parent, 20% to the NCI. We'll use this format later when we have some differential items, so I'll introduce it now. And notice that I did not extend the sales and cost of goods sold over and the other expenses for 80 and 20%, because for our purposes the parent is going to get the last number, or the net income number, is going to be brought over. We see that the dividends are $154. The parent's going to also get 80% of that. So if we go through the journal entries, remember that, again, I can't stress enough that we're using the equity method of accounting during the year, and all these entries that we're going to do is going to end up in the investment sub. Let's do the first current year activity entry, which is the net income. The sub has net income of $167,940. We're going to debit investment sub, credit income from subsidiary for 80% of that income. We'll do the same thing for the dividends. The sub had dividends of $154, of which the parent will get 80%. 154 times 80%, $123,200. So we're going to debit cash, credit investment subsidiary for that amount. If we recap those, we'll have this. And what we need to do from here is start to do the things we did in Chapter 2. The first was prepare our book value schedule. Notice that in this schedule, just like earlier, we added a column for 20% for the NCI. The NCI is going to get 20% of everything, the common stock, retained earnings. Then we'll go 80-20 for the net income and dividends as well. We'll add those columns up, and we'll see in a second that those do agree to our investment account, and we'll see what we do with the NCI in just a second. When we reconcile our investment subsidiary, we've got the beginning balance, the initial investment, any net income, again at 80%, any dividends at 80%. We get a $608,952 balance, which agrees to the investment sub on our three-part worksheet. We're going to add one more schedule with the NCI, and that's going to be an NCI reconciliation. We're doing this NCI reconciliation a little before we need to, but since we're doing all the reconciliations, we'll do them together. We'll see that this is going to come into play when we assign the NCI's value on the three-part worksheet. But the big thing to remember is that during the year, the parent nor the sub has an NCI account on their records. This NCI value comes into play each and every time we consolidate, and it's going to come into play through the eliminating entries. When we reconcile our NCI, a couple of things to note. One is the NCI is going to be on the balance sheet in the equity section, and the equity items have a credit balance. So we've switched everything over on this. The normal balance is going to be a credit as compared to a debit for the investment sub that we just saw. It's going to be the initial assigned value, 20% of the net income, 20% of the dividends. As you can see here, there is no balance on the parent and the sub. We just mentioned that. That 152 value will get assigned when we do the EJEs. So let's go ahead and start the consolidation process. Here we have the three-part worksheet, and we'll start the EJEs. Our first EJE is going to be the current year activity between the parent and the sub. We're going to get that from our book value schedule. We just computed that. It's going to be 134 for net income and 123 for dividends. So we'll record our first EJE, income from subsidiary debit, 134, 352. Credit dividends and investment sub for 123, 200 and 11,152 respectively. The second EJE is new in that we have to account for the NCI's portion, or the 20% that they get of the sub. That information, just like EJE1, is going to come from the book value schedule. So what we have to do is we have to assign 20% of the income to the NCI and 20% of the dividends to the NCI. We're going to establish a new account, income to NCI, $33,588, credit dividends, and credit the NCI equity account for the difference between the two. The next thing we need to do is record the subsidiary's equity, or eliminate the subsidiary's equity at book value. That again will come from the book value schedule, and that was very similar to EJE1 that we made right after acquisition. We're going to debit common stock, debit retained earnings, credit the investment sub, and credit the NCI for the values that we identified in the schedule. And then we kind of recap everything, put them all in one place, just a combination of those EJEs there. Let's look at the three-part worksheet with the EJEs posted. A couple of things to point out. You can see on the income sub line that we're going to debit that. And the big thing, in which is new in this chapter, is we've assigned $33,588 to the income NCI. Similar to before, the information is going to flow from the income section down to retained earnings, down to the balance sheet. We see that we have 0 income sub, 0 investment, and notice we have a value of 152,238 assigned to the NCI. If we go back to our reconciliation of the NCI account, that does agree. Another thing to note is here on the income to NCI, we have a subtraction. And remember though, we debited this. We've got revenues and expenses up here. This is a debit. This bracket on this number here represents a debit or an expense item. So it's going to be subtracted to come up with our number. Here's a clean version of everything. Well, the last thing we need to do is to compute consolidated net income. And similar to before, we're going to start with the parent's net income, subtract out any income sub to get separate operating income We'll add to it the subsidiary's net income and come up with consolidated net income of $869,040. And another thing we're going to add is we're going to have income to NCI, which is going to be a subtraction from that 869. And we're going to introduce another new term, income to controlling interest. The controlling interest is going to be the parent. The term controlling interest is just a formal description of all the income that the parent has earned in this particular year.